Hello, this is a video for IME 315, Financial Decision Making for Engineers. My name is Liz Schlemer, and this particular video is on gain of asset sales using MACRS depreciation. So there's 5 topics that we're covering in this class, and this particular topic falls under investment analysis. So in an overview, when we're thinking about making an investment, we have an initial amount that we're investing that needs to be depreciated over time, and then we need to calculate the after-tax cash flow from that investment. And then, other things we need to think about is working capital, sale of assets, and particularly after-tax salvage value. So in this video, we're talking about the after-tax salvage value, which another name for that is gain on sale of assets. I'm going to illustrate this with an example. A company you work for has been asked to evaluate the investment in a new CNC machine. The machine cost $100,000 and can be depreciated using MACRS 5-year recovery period. After full implementation, the machine will decrease labor costs by $50,000 per year. There will be a higher utility cost of $5,000 a year. It is estimated that the machine will be used for only 4 years and can be sold in year 4 for $20,000. The tax rate is 28%. Is this investment justified using net present value at 10%? So I've put the key values from this problem over on the right, and I've also drawn a cash flow diagram. So when we're looking at these calculations, the first thing we need to do is determine what the depreciation schedule is. So what we do is we look up the 5-year recovery period from our table, and we get the percentage for depreciation for each of the years. And I go ahead and do for the first year, it's 20% times 100,000, and then the second is 32%. Then 19.2, and then what happens in year 4 is that it's 11.5, but because of half-year convention, we only can depreciate a half of that because the IRS requires that we assume the asset was sold in July, so we only get half a year of depreciation. So that's an important thing to remember. If you stop depreciating before the end of the recovery period, you need to take half a year of depreciation in the last year. So another thing we can do right now is to actually calculate that after-tax salvage value. So we're going to sell the the CNC machine for $20,000 in year 4. And what we need to do is figure out what the depreciation, the book value is, and it says year 3, but it needs to be year 4. In year 4. And so we take $100,000 and we subtract out the 4 years of depreciation that we calculated above to get a book value in year 4 of $23,050. And then the gain is actually a loss of $3,050. And so the taxes on that are 0.28, which end up is 28%, which is a minus 854. And you can see when I actually do the calculation for after-tax salvage, I take the selling price of $20,000 less the taxes I paid, but it's a minus tax, so I'm actually adding that value. So the after-tax cash flow is $20,854. Now I know it's a little confusing to think, how could I have negative tax? But what that is, it's a loss that can shelter income in another part of the company. So the net cash flow is actually more than the sales price. So I went ahead and I put all these values in here. I think it's important to look here at the cost of goods sold. What I said is they're going to have lower labor costs of $50,000, so that's a minus number. And so that means the gross margin, because it's 0 minus a minus 50,000, is a positive 50,000. Operating expense is the utility values that we go ahead and use. Increase utility cost, and then I have depreciation. It's laid across here. That gives us taxable income, taxes at 28%, net income, which is the difference in those values. Then I add back depreciation, it's the same number as up there, to get the cash flow. And then in the last year of this project, I have the sale of the assets, or the after-tax salvage value of $20,854 that I calculated on the previous slide. So I add those two together and I get $54,000. So if I look at the cash flows, this is what it looks like. That's the cash flow from the previous slide, just laid out on the cash flow diagram, and then I do a net present value calculation to get the net present value of $34,580. So I hope that you see from this the way to use MACRS depreciation when we're doing sale of an asset and also in the total calculation of cash flow. This particular video is really supportive of the concept of investment analysis.